Good morning. I'd like to thank all of you for taking time from your day to participate in Global Strategic Webcast. With me today are my colleagues, Nick Botticelli from Chicago, Matt Underwood in North Carolina, Don Callahan, who's here in Scottsdale, Dan Chesson, who's here in Scottsdale, and of course me, Kurt, who's in our headquarter office today. Over the last couple of quarters, we've talked an awful lot about the challenge of fixed income investing, given such low yields from traditional core investment grade bonds. Our team has been working diligently and focused on several alternative strategies to improve cash flows and total returns of our portfolios without incrementally changing the overall risk profile of portfolios. So today, we're going to spend about the next 25 minutes introducing a very unique strategy that our team has been researching and has improved internally. And then I'll be following up with all of you about the specific recommendation in your portfolio and how we think this will fit in. So I'm going to turn now the webcast over to Nick and to Matt, who will be reviewing the specific strategy.
Thank you, Kurt. Thank you, everybody, for attending. We're going to cover two broad topics today. The first one is just a global market update. We're about 6 weeks through the fourth quarter, so we just wanted to give an update on how the markets are doing. That's going to be the shorter part of the presentation. And then we're going to spend the balance of time covering the Blackstone B-REIT investment, which is a private real estate investment with, we think, a lot of benefits to the portfolio that we want to introduce to you today as we make our recommendation. So how's the quarter been going? So fourth quarter started off really strong. September ended in kind of a downward trend to the market, and we had to bounce back starting in October. Through the first 2 weeks, we're up almost 5%. Then, COVID-19 cases coming back, a resurgence, and more people discussing the election uncertainty kind of drove markets down, and we were actually negative for the month as we kind of rounded Halloween. Election day came around, and it seemed like Wall Street actually was going to warm to a kind of a divided government, and the markets kind of had a nice, several point pickup post-election. And then we got the next leg up as Pfizer came out with their announcement about their 90% effective vaccine, and then Moderna came out a couple of days later with their announcement, sending global equity returns up, roughly 8% for the first 6 weeks of the quarter. Some of the other metrics, we thought were interesting to share today. The first one on the top line here is U.S. unemployment. So you see unemployment was about 3.5% prior to COVID, spiked up to almost 15 percentage points during the COVID high. Since then, we've had, nice little improvements to employment over time. We've kind of cut that 15% number in half, and the most recent reading was about 6.9%. The second metric here I'm going to discuss is what we call the VIX. It is a market volatility gauge. So what this tries to do is estimate how volatile the market's going to be going forward. So, how many plus or minus 1% days are we going to see in the market going forward? Pre-COVID, the number is about 17, closest to the long-term average. During COVID, that spiked to 83. Basically meaning that, looking forward, we're going to have a lot of volatility in the markets. That's come all the way down to the 23 range, not as low as 17, but, pretty calm relative to what we saw late first quarter. One of the things we're going to discuss a lot today is how, the yields, traditional fixed income and the yields that they're providing our portfolio are not going to be as beneficial as they have been in a total portfolio context over, basically the last, 50, 60 years. And what I'm looking at here is the U.S. 10-year Treasury yield. So one of the most talked about, consider it a risk-free asset. And 2 years ago, almost today, you could have gotten 3.2% yield from investing in this in 10-year Treasuries. Pre-COVID, you saw it kind of came down there to start the year, down to 1.6. The lowest point in COVID, it was half a percent, so really, really low. That's climbed up a little bit to just under 1%. In yield, but still nowhere near long-term contributions that's provided to the portfolio, and it's not going to do a lot to provide income to a portfolio going forward. The last metric here is U.S. equity valuations. It's one of our metrics that we look at to see, how expensive or cheap U.S. equities are relative to their own history. And you see, the low in 2009 was down to 15. The average has been 17 to 18. Now it's kind of getting closer to our 10-year highs of 33. So it's currently around 32. So, U.S. equities, as they continue to run, as they post positive returns, are getting a little bit more expensive. kind of looking at the whole investment landscape, and I'm going to focus on the fourth quarter. Hopefully this is a slide that is becoming pretty familiar to everyone. If you look at the top line at global equities, this looks at all equities across the world. Just during the fourth quarter, that portfolio of assets is up 8.1%. So a very, very strong first 6 weeks of the quarter for global equities. Pretty much every equity asset class has been up this quarter. But I think, the big story this quarter is that the rotation that we're seeing from growth to value in small cap and non-US stocks. So as you all recall, during the summer, the second quarter and third quarter, a very small subset of growth stocks were leading the charge and really driving all markets higher. And it wasn't a very broad bounce back for all stocks. And we mentioned this to everyone during our most recent meetings about the concentration in the market and how it's usually pretty unsustainable, and it played out here pretty quickly. So if you look at the value, Russell 1000 value up 10%, small cap up 17%, and non-US markets up 10 and 11%. So very strong returns for the fourth quarter for those asset classes. Looking at alts, commodities, and natural resources and REITs, pretty strong returns from there also, 5 and 7%. So a nice little bounce back for those asset classes also. And then if we look in the bond portfolio, the first two lines, more of our traditional higher quality bonds, munis, governments, investment grade credit, not a lot of return this month, 10 basis points to 0 to flat. And this is one of those problems that we're going to mention a bunch on this call, but we really don't see these assets providing a lot of yield or return going forward to client portfolios. High yield bonds had a nice little run here in the first 6 weeks, up 3.7% as those kind of lower quality credits continue to perform well. When we look across, again, the same asset classes, the landscape across global yields, the first bars here on the left, all the shades of blue, are equities across the globe. And, those average out to about 2%, which is kind of in line to the long-term, expectation for what you would get for for global equities when it comes to dividends. But usually, when we look at these green bars, you're usually expecting to get a higher yield out of your fixed income portfolio than you are out of the dividends from your stock portfolio. And you see today, that's just not the case. Whether it's a municipal bond portfolio or government credit portfolio, at the most you're getting is 1% yield out of those portfolios. High yield bonds are still providing a nice relative pickup in yield at 4.6. What we're going to talk about here mostly going forward is this red bar all the way to the right. And that's BREIT. That is that Blackstone real estate portfolio that we're talking about. And this has had a historic annual distribution rate or yield of 5.6% that's paid monthly. So a nice little pickup over pretty much, the other major asset allocations in your portfolio. On slide 7, we look at some of these fixed income asset classes a little closer and see how much their yields have changed over time. And for each one, US 10-year, investment grade, and high yield, we look at what the yields were in 2010, 2015, and 2020. And you'll see the case is the same for pretty much all of them. If you compare from 2015 to 2020, big significant drop-offs in yield. 10-year treasuries down almost 1.5 percentage points. Investment grades down 1.3%. You're only getting 2% from that asset class from yield going forward. You were getting close to 4% 10 years ago. And high yield dropped by 3% from what you would have gotten in 2015. So relative to the other asset classes, high yield is attractive, but relative to the yield you would normally expect from high yield, it's much lower than you would have received 5 years ago or 10 years ago. So, this is the investment challenge that we're going to talk about today, and one of the solutions that we've come up with through our research and kind of narrowing down a list of potential investments, and we've zeroed in and approved this one. So Blackstone Group, some of you know already because some of you have some other exposure to them, but they are kind of the cream of the crop. They're one of the best and highly regarded private market managers in the world. They provide institutional quality portfolios. And the portfolio we're talking about today is a very stabilized real estate portfolio that has strong yields and returns that we think will improve those factors in a client portfolio. And it's also another diversifying asset class in your portfolio, which helps us kind of spread out the risk to individual asset classes. As you can see, the portfolio's significantly large. It's worth $36 billion today. They have almost 1,200 properties, and the occupancy, which is an important factor, is 94%. These are some of the actual properties in the portfolio. So we have an industrial property here in central PA, a multifamily property in Phoenix, Arizona, a Home Depot retail location in California, and a Courtyard by Marriott in Austin, Texas. So a little bit on Blackstone and on BREIT. So again, just a couple more points on Blackstone. So one of the world's largest alts managers. They were founded in 1985, so they have 35 years of experience. They manage a large amount of money. They manage $564 billion, and 167 billion of those dollars are just real estate assets. And backing that is the research and the experience of 591 real estate professionals globally. So they have a lot of people who are out there trying to find the best properties to invest in and put into this portfolio. When we look at some of the benefits, the major benefits of the portfolio, they're listed here on the right side of the page. So I think our number one is income driven. The income here has been very stable and consistent. And we think, again, it's going to add a lot to your portfolio over and above what we're going to get from traditional asset classes. They have a very diversified allocation. We're going to show you that both from property type and geography. The liquidity is attractive. Again, private markets, usually people get a little skittish because you think you got to lock up your money for 7, 10 years or more. The liquidity in this portfolio is a 1-year soft lockup. After that, you can get access to your money on a monthly basis without any penalty. One of the other things is the tax structure. So it's a 1099. So we're not adding another K1 to that your accountants have to deal with. And you'll see from what Matt's going to go through, a very strong and consistent historic performance. The last slide I'm going to cover here is just how does this real estate investing work? And this is very, very high level, but you as investors, you make commitments to the BREIT fund. All the money gets called at once, so there's no subsequent capital calls. You get instant exposure, instant allocation in your portfolio. BREIT has gone out and in turn, they buy a lot of stabilized real estate, which tends to be, almost probably 90% of the portfolio. And the debt, they also do some debt opportunities, which is a much smaller part of the portfolio. Today, it's around 10%. Those investments then return capital, return rent payments or servicing payments back to BREIT, and then BREIT returns the majority of those dollars back to the investors, back into your pocket on a monthly basis. So with that, I'm going to turn it over to Matt now, and he's going to go over some of those benefits I covered in more detail.
Thanks for that, Nick. So one of the reasons why we approached Blackstone, and particularly this strategy, was really to answer that question about what do we do in a low yielding environment. And so BREIT definitely has a good trade-off of risk and reward to be able to generate income while still giving us a risk profile that we're comfortable with for our client portfolios. This strategy has a consistent distribution structure, has had very level distribution since inception, April 2017. That distribution rate's about 5.6%. Now, 5.6%, is actually a pretty decent spread from where things are right now, compared to the risk-free rate. And so one of the things that we think about is with these credit, these high credit quality bonds. 3 years ago, closer to the inception of BREIT, you were able to get one of those risk-free bonds for over 2%. So that's that 10-year treasury yielding over 2%. BREIT at that point had about a 3 percentage point spread or an annualized income buffer above that. Now with these risk-free rates coming down and that stability of that distribution, now the relative income buffer is much higher. So not only is BREIT a good example of a strategy that we use on an absolute basis, the fact that it generates consistent returns, but on a relative basis, it's become much more attractive because of the fact that you're getting a higher relative spread to other high quality bonds in the market. Go to the next slide here. Now, generating that income is one facet of the equation. The other portion of it is understanding the risks of the portfolio. So one of the things that we really liked about BREIT was the portfolio construction and the fact that they have a diverse subset of sector allocations and geographic allocations. So this is, as Nick said, around 1,200 properties that are stabilized income generating real estate properties, $36 billion in total, and they are broadly diversified across sectors. So the largest components are multifamily, industrial, and net lease. And one of the things we really liked about that particular mix was the fact that the portfolio was underweight some of the more COVID sensitive sectors such as retail and hospitality. So you get the benefit of these really robust cash flow earning sectors of the market, but you're also making sure that you're not putting all your eggs in one basket. In addition to just the sector allocation, so the types of properties that are being purchased, they're also geographically dispersed. So when you look at the spread of BREIT's properties across the footprint, you notice that they have a large chunk in the West Coast and then the Sun Belt. So sort of on the east and southern, southeastern portion of the country, and all of these regions have higher than average, wage growth, the demand for properties and the need for these types of core sectors such as multifamily and industrial in these expanding economies, which are growing faster than the national average. That demand is only increasing. So we feel that the ability for BREIT to maintain its income generation capabilities is really strong. Next slide here. This is just a little bit of a deep dive into that sector allocation. So the largest sector is multifamily. We see in the right-hand side there that this is almost 40% of the portfolio, so a significant chunk. The geographic dispersion is over on the left-hand side. So you can see we have that West Coast portion. We have the Sun Belt, sort of like that Southeast but a coast-to-coast footprint. Now, these multifamily properties are really these higher quality, renovated, highly amenitized, resort style living facilities that again are expanding in rapidly growing regions of the country, and actually gaining some support from the trend of people with housing prices being so high, exiting their properties and looking for temporary housing in a high quality place to be able to wait out the pandemic and other lockdown considerations. Next, we're going to look at something a little bit more B2C, B2B. So industrial is more business to business type real estate. So this isn't individuals going into sort of a luxury apartment complex. These are speaking more about warehouses. Okay, so these are again geographically dispersed, from coast to coast, California all the way to New York, Massachusetts. Again, significant portion of the portfolio. But these are going to be these large industrial warehouses with tenants such as Amazon, Lowe's, Starbucks, Whirlpool, Williams-Sonoma, and these tend to be agreements. These leases are in place that have a little bit longer life. They have a 4-year weighted average lease length, and no more than 18% of the square footage in these facilities is expiring in a single year. So what this really says is that these properties they're contractually obligated for a longer period of time. The tenants are high credit quality tenants who have a lot of cash flow for debt service. And so these are actually a really good cash flow generating properties with very low credit risk. So this is one of the things that again we thought was a big plus. This actually also helps with some of that COVID diversification, as these types of properties are supported by the growth of e-commerce. We'll go to the next one. And so rolling this all up together, we have two components of return here, the income generation and the capital appreciation of the assets themselves. With those two things together, BREIT has actually had a really good track record since inception. April 2017, inception to date, it's earned 9.2% annualized. That's a positive return in 39 out of the last 42 months. And when we think of downside in these returns, we can't just always assume that everything goes up. But when things did go down, the deepest that they did was in March 2020, as with most risk assets over the last couple of years. And BREIT was down a drawdown of 8.1% for the month of March 2020. It fully recovered that amount in less than 6 months. So the other 2 months of the 42 months that it's been in existence were only down 8 basis points, or 0.08% in February 2020 and 0.12% in December 2018. So overall, this is a portfolio that that targets returns that are very equity-like, but with a downside risk profile that's significantly safer than a broad equity index. We dive a little bit deeper into the amount of risk the portfolio holds and experiences, we can actually show that through an empirical analysis that the private real estate strategy has experienced 71% less volatility than public REITs. For this particular strategy, again, that worst 1 month return was March 2020. And just as a comparison to some of the core asset classes that we would normally put into a portfolio, BREIT actually showed a lot of resilience during the COVID drawdown. So being down about 8.2%, where investment grade corporate bonds were down almost 8% at 7.5%. High yield bonds were down almost 12%, and publicly traded REITs, which are another common way to get real estate exposure, were actually down almost 20%. So when we think of constructing a portfolio with these types of strategies, we think of the longer term risks of holding these strategies through longer periods of time. And so we look at the volatility, which is on the right-hand side. So this realized volatility of each of these different portfolios, BREIT actually had the lowest level of volatility, which is a measure of risk, even lower than investment grade corporates, high yield bonds, or public REITs. So you actually get the downside protection with a longer term, lower volatility profile and still very robust returns because of its focus on high quality income generation.
So we've put a lot of thought also into how we're going to allocate this to different client portfolios, and we've come up with a generic solution for whether a portfolio is 80% equity and 20% bonds, or if it's very fixed income focused with only 20% equity and 80% bonds. So Kurt and I will speak to everyone on a case-by-case basis to make sure that the allocation is customized to your exact characteristics and fact pattern. But we just wanted to kind of give an example of what, for a basic 70-30 portfolio, 70% equity, 30% stocks, how that allocation would look. So we take about 2% of that allocation from equities and about 3% from fixed income to make that 5% BREIT allocation. For a portfolio that is more fixed income centric, we would recommend a higher BREIT allocation, and somebody that had a more equity centric portfolio, your allocation to BREIT goes down a little bit. But no matter where you stand from an equity fixed income matching, across all those relationships, we find we get increased income, a higher return, lower risk in the portfolio, and better risk adjusted outcomes. So it's exactly what we want to see when we're making a new investment into our portfolio. Just to go through a few of the terms, I know we talked about a bunch of them, but I'll just go over these on a high level. So again, it's a Form 1099, which we think is attractive. This is a perpetual life, ongoing portfolio. You can kind of get into it whenever you want. You can get out of it whenever you want after that 1 year. Distributions are monthly. As Matt said, they've been very consistent going back in time every month. The management fee is 1.5%, which comes out of the value of the portfolio that gets posted every month. So that just gets taken out of the gains. There is a performance fee. So once the portfolio returns 5%, this is on an annual basis, the manager starts participating in some of that upside. So above 5%, you, the investor, keep 87.5% of the gains, where Blackstone, the manager, keeps 12.5% of that. A couple of other benefits: the minimum investment is relatively small, so it makes it accessible to kind of all of our clients of varying sizes. The other nice thing is that some investments you have to be an accredited investor or qualified investor. The suitability standards here are even lower, so they're listed on the page. So this opens this investment to the majority, if not all, of our clients. So again, another benefit to this investment. And just kind of wrap up the investment rationale summary. Looking forward, as we look at your expected returns for a basic 70-30, 60-40 equity bond portfolio, the returns are just significantly lower than what they've been over prior years. And that's what's going to happen when bond yields come down significantly and equities rally and keep on reaching new highs. So we want to break the mold a little bit, think outside the box, bring new investment ideas to your portfolio that are going to help achieve some of those long-term returns that we expect and provide the income that you've come to expect in your portfolio. And we think BREIT is a great blend of bringing those things to the portfolio to increase the yield and increase the return. You know, kind of have all the benefits here on this page. I think we spoke about all of them, so I won't go over again. But I think the one I do want to mention that we haven't mentioned, you know, for our high net worth clients, this turns out to be a really good estate planning tool. A lot of the dividends, as Matt mentioned, are treated as return of capital. So a lot of the taxes are deferred until you actually exit the portfolio. But for an estate planning tool, if the shares are then transferred to a child, there's a step up in basis. So those deferred taxes never get realized. So, you know, another benefit there for the high net worth clients. So now I'm going to turn it over to Kurt, who's going to, you know, wrap up the webcast.
Great. Once again, thanks for everybody taking time for your day to go through this. This structure, the Blackstone vehicle that we've referenced, is actually structured as a limited partnership. And once again, our firm does not have authority to allocate any capital to this strategy without your specific written authority. So Dan Chesson in our office will be helping put together the forms. They can be DocuSigned to make it relatively easy. And this investment can be held directly on your custodial statement. As Nick mentioned, it's a one-time capital call, so we won't have to be dealing with capital calls consistently. Our intent is to implement this in early January. So from a mechanical perspective, we would be raising cash in client accounts in mid-December. The capital would be drawn, and once again, you'll see it on your December 31 as a pending investment, and then you would begin to earn income in January, and the first dividend would be paid in February. And we'll be speaking to each of you about a specific asset allocation in this investment based on your total asset allocation. So with that, I want to thank you again for your trust and confidence in our organization. It's a privilege to work with each of you, and we wish you a safe, enjoyous Thanksgiving holiday. Thanks so much.